Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
And we're back. Like it or not. Just kidding. Hey, I thought I would start off the show just by talking about the upcoming workshop we've got going on. It's actually going to be September, so you got a few weeks to sign up for it. We're going to be talking about the highest rate of returns you can get on quote unquote safe investments, things like government bonds, CDs, corporate bonds, funds that invest in them. So if you'd like to kind of get a handle on where things are currently with the safe investments, then feel free to sign up for that workshop. Just go to bullingtoncapital.com. And along those lines, everybody should have some amount of money in something that's relatively safe. Even if you're young. The younger people, I hear this quite often, put 100% of your money in the stock market. That's not a good idea. First of all, the stock market's going to be down a lot from time to time, and you might not have the temperament for that. But more importantly, when it is down, you've got no dry powder left to take advantage of those lower prices. And that's a missed opportunity. Not necessary to be 100% invested. And, that's my opinion. Everybody's entitled to their opinions. And I just think that, when you're investing, you always want to keep a little bit of powder dry, no matter how old you are. Even if you're really, really young, have a long time to wait, I think you're better off keeping something available, because we know for a fact that markets are going to fluctuate. That's what we know for a fact. So when that fluctuation happens, if you got some money in something relatively safe, you can take advantage of those lower prices. And when things are not all that safe, you'll be glad that you've had that money in the safe. So it's there's a win-win there. By the way, feel free to call in 216-901-0945. If you have a phone call, question, or comment today, 216-901-0945. And I thought I'd talk about quite a few things. Safe investments, that's going to be the topic of the upcoming workshop. So I'll kind of leave that for that. I'm going to talk a little bit about the cannabis stocks that a lot of people have been asking about, not because I think it's a good idea, but people keep asking me about that. I get asked about that at least once a week, which is kind of interesting. And it's going to be a real thing. That's my opinion. It is a real thing. It's going to grow. It'll grow in popularity, it'll grow in acceptance. And I think it's actually too early for most of these companies, incidentally. You might get lucky. You can buy a penny stock that actually ends up making it when Procter & Gamble, I'm not Procter & Gamble, actually they might come in, but right now you've got an awful lot of big companies like Cargill, Archer Daniels Midland, you've got the big drug companies, Pfizer, Merck. These guys have billions of dollars to invest. When they feel like it's really safe, they will go into those marketplaces and they're going to dominate because they've got more money than a lot of the others. They can basically drive the costs down and bring those products to the general public. So that's my opinion on that. I think it's a little too early. I think that if you're doing that, you're not really investing. Most of them are gambles. Most people that are investing in those don't know the difference between gambling and investing. So, and I'll tell you what my definition of gambling is when it comes to investing. When you're putting money into a company that doesn't have sales or profits, that's gambling. That's not investing. The company doesn't have sales or profits. You're investing, you're gambling. Basically, the odds are against you. Because it's very difficult to run a company, especially a public company, who's got a lot of extra expenses for filing to go public and maintaining that. They've got a lot of extra expenses, and if you don't have sales, that's really, I think you're asking for it. If you don't have profits, sooner or later, you've got to have profits. That's why people invest in businesses to begin with, so that they can get, so that the business is profitable. And if the profits grow, then the share price goes up. Now, the share price also goes up because people think they're going to have profits one day. But that's gambling. If they're not profitable, or they've never been profitable, you're making a long shot. That's a long shot bet to make. That's a bet. That's not an investment. If you're looking at a company that has cash, it has dividends, yeah, that's an investment. If they are paying a dividend, normally they've earned a profit from the sales that they have. So I'll kind of leave that alone right now. Can come back to it at other times. But essentially, when you're investing, you want to kind of get an idea of what kind of risk you're taking, because it's not necessarily a bad thing to want to invest in a startup company. You just don't want to put a lot of money in it. You just want to kind of gauge how much you're putting in there. And if you've got more than 10 or 15% of your money in something like that, you might want to think about that. I think the risk is significantly too high. In fact, my opinion on investing over the years has really changed quite a bit. I think today it's more about managing the risk. It's not like stocks are not going to go up sooner or later. It's not like interest rates aren't going to fluctuate. That's all going to happen. So trying to get a handle on what you feel like is happening right now is kind of hard to do, because the media likes to talk about a lot of stuff that's not really important. They talk about it because it sounds good. They can get your attention. When they get your attention, if you're on cable, they know you're viewing that. They can track that, especially with the streaming services. On the streaming services like Hulu, like Netflix, like YouTube television, they know who you are and what you're watching, and they can charge money for that. And they do. That's how they pay a lot of their bills. So I just completely lost my entire train of thought there. Don't get old. Just don't get old. But anyway, I was this week, during the week, I was thinking, I'm getting asked about these pot stocks. What do you think of this company? I look it up, and it's a penny stock. Geez. It's okay. That's part of my job, is answering clients' questions. So I looked it up, didn't find anything that was really valuable. I'll let you know when I do. I can also tell you how other industries have developed over time. And you look at what they've done and how many times it's happened that way, and it's more than likely that the larger companies will probably dominate that. I did find something that was really interesting. There are beverages that they're making. They're extracting from cannabis, from pot, and a lot of beer manufacturers in Canada, some pretty big companies, are investing in those. And that's kind of interesting. Their laws are slightly more progressive than ours are. So they're literally starting to make these beverages from pot, from marijuana, and they're extracting it. And I think it's interesting. I'd love to see what the side effects of that stuff is. I'm not going to try it personally, but I'll find out. They'll report on that. So that's something that I wouldn't have predicted, that you'd get some really big beverage companies entering that space using the same raw materials that they would use for all the other products that are going to come on. And by the way, there are a ton of products that are already on the marketplace. They're bringing new ones out. That pace has actually slowed down quite a bit, but there are a ton of different products related to that. So that's what makes this really difficult. It is such a fragmented marketplace, and I don't mean to spend all this much time talking about it. It's just that I've gotten so many calls, and I'm going, yeah, well, I think it's a little bit too early. Most of these companies are not profitable yet. A vast majority of them are not even listed on U.S. exchanges. So we just have to wait. Just have to try to be patient and see what happens. In the meantime, I send out a newsletter. I send it out about once a week. I was thinking about slowing that down a little bit, maybe every other week. But here's how I choose when I'm going to send a newsletter. I subscribe to a service that allows me to peruse articles that come from CNN and come from Forbes, Barron's. I think there are about 250 publications, writers, Bloomberg. They all publish this stuff. It's all been picked and selected by the company that I use to provide the material to myself. They make suggestions. I read the suggestions and then I send it out. I take the ones that I like and I send them out. And I think it's kind of funny if you're a client or if you've inquired to my website and said, hey, can you put me on that mailing list? You're on that email list now. And some of my clients, after I've already explained this, came back and said, hey, did you read that article? I go, who do you think is selecting those? I'm going through and I'm reading them and I'm picking them. Yes. So those are coming to you because I'm picking them, not because some random robot selected it somewhere. And I think they're very helpful. In fact, this last week, I sent out 2 articles. One was on value investing. Last 5 years, value investing has been smoked by growth investing. The Facebooks, Amazons, Googles, Apples of the world, okay, they've been going up at, I don't know, probably twice the rate that the old stodgy dividend-paying stocks have been going up by. The ones that we would call value stocks. So you're looking at growth versus value. Growth has been the number one performing category now for about a little over 5 years. And at some point in time, value has a tendency to come back into favor. That's just the way that's worked for the past 100 years or so. And when you look at the value, how much cash these businesses are generating for every dollar that you're going to pay for the company, it's pretty substantial. And they're substantially higher than the cash that you would get if you got to keep every share of Facebook. Or if you got to keep every share of Google, got to keep all the profits in that earnings per share. That's your money. The yield that you're getting on that is a fraction of the yields on some of the other stocks because they've also grown, but their share prices have not gone up. So I got an email from one of my clients, which I think was interesting because that means somebody's reading the stuff that I'm sending out. And he read the article and he said, hey, what can we do about this? And my first response was, well, I've actually been holding some of those in the portfolio anyway. Got some funds in there. So they haven't done as well. They're starting to do a little bit better. So number one, I've already been paying attention. I've already taken some steps in that direction. But number two, we've got a model that I really like a lot, and it's a value-oriented model, and we're going to talk about it in detail at that seminar on safe investments. Because when you're talking about stocks, the share prices fluctuate a lot. The share price, I can't even speak this morning. The share price fluctuates based on perception. Perception changes almost as quickly as an 8th grader changes boyfriends or girlfriends. They switch around a lot. Their perception changes a lot. When the share price goes down and the company's generating a lot of cash, if the company's generating a lot of cash and its share price is down, there may be an opportunity there. And I run a model. I call it the Bullington Capital Value Model. BCAP value. If you have an account at Folio, that's what you'll see. Been running it now for almost 2 years. Past 12 months, it's done really well. Past the first 6 months that it started, it did not do well. It's made that up and then some. So that's kind of how that works, incidentally. And if you didn't know that, you would get shocked. And when you're investing that way, the chances of some of those stocks continuing to go down, because remember, these stocks, they're already down. When the share price drops, the cash yield goes up. I'll go into some math on that on the next segment of this program because we're getting closer to the commercial break. But the share price goes down, the cash yield goes up. So if the yield is up and they're generating a lot of cash, that's when you want to start looking at those stocks. That's called value investing. And I've got this model, and I actually have an intern who's working at Case, and we're going to put up a website so that you can follow these models along. You don't actually have to have an account to do that. And we're going to show you where to go, how to do it, and we're going to provide the stocks for you. It's going to be a small monthly fee. It's going to be a separate business. It's actually, I'm going to help him. I'm doing all the consulting. He's doing the heavy lifting. He's going to work with the programmers and the customers, and I'm just going to provide the research. So that should work out really well. And we're going to talk about that at the upcoming seminar, because this is a really good thing to do. And by the way, you haven't been able to do this up until the last few years. And it's because of the technology that's advanced so much so that it allows you to do a lot of things that only mutual fund managers had been able to do in the past. Now you have the ability to do it. Is it easy? Well, it's easy if you do it the way we do. It's actually easy. I don't think I should say simple. Easy is another concept altogether. Easy has many meanings. When you're talking about psychologically, investing is almost never easy. It's all psychological, in fact. It's all between your ears. There are lots of things that work exceptionally well that will get you where you need to go along that path towards financial independence. I used to call that retirement planning. I'm not calling it that anymore. Financial independence, the day that you can walk away from a job and still be able to support your lifestyle. That's financial independence. Now, whether that happens when you're 30 or 69, at some point in time, you hope that you can walk away and not have to worry about how you're going to pay your bills. And the way you do that is you can build a business. That's one way. You can build a business. You can invest in other people's businesses. That's what the stock market is for. Not everybody has enough money to be able to start their own businesses, so they raise money by going to the public. And they share their profits. That's how that works. In fact, did you know that in Muslim religion, it was illegal to charge interest? So they didn't think that was fair at all. If you wanted to invest, you were Muslim, you had to sell stock. How cool is that? Anyway, I hear the music. That means the commercial break is just upon us. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. In times of trouble, where can I turn when hope seems lost? And we're back. Excuse me. Hey, if you'd like to call us, 216-901-0945, 216-901-0945. Got a workshop coming up. If you'd like to talk to me about your investing, feel free to give us a call during the week in the office. We typically see people Tuesdays through Thursdays, so I work late those 3 nights and can arrange to see you. If you'd like, we can just talk on the phone. That's okay. Got a couple of really nice tools I'm going to be showing at the upcoming workshop that have been constantly being improved. One of them is a pre-retirement planning tool. Let's say you're planning for retirement. You've got a kind of goal there. We'll talk a little bit more about that on a little bit later in the show. And one of them is if you're already retired, how much could you reasonably expect to spend? So, and these tools are very simple. They've really improved a lot. I'm just amazed. I'm flabbergasted that these guys are putting the kind of money into what they're putting into to help us out. And they're doing a really good job of simplifying it. They're making it as simple as they can, which I think is really important. Because when you make things really complicated, it's a big creator of stress. Complication leads to stress. Simplification, less stress. It's that simple. So I've got these 2 new tools. I really like them a lot. If you're a person who likes to look into the nitty-gritty details, by the way, there is a a really dangerous side effect to looking too closely. You know that old saying, can't see the forest for the trees? Yeah, well, that happens with financial planning all the time. You get so caught up in the minutia on some little tiny thing that for some reason is like a burr under your saddle, and it basically distracts you from the most important parts of your plan. I see that all the time. All the time. So we're going to focus on the basics there. I'll show you those tools, by the way, because they're not that hard. And just about anybody can understand, I think, when it's being explained. And it's, like I said earlier, it's a really big advancement, I think, in the whole software industry to try to simplify something instead of trying to make it incredibly complicated. So I'm a big fan, and we'll bring that out. Because it doesn't really take that long. You see how much you're saving, what your age is, what kind of portfolio you're looking at. It'll give you projections. And by the way, their projections, this is from BlackRock. BlackRock is a firm, if you don't know who they are, they're the largest asset manager on the planet. They passed Fidelity and Vanguard within the last few years. They actually manage more money than both those guys do. And not together, but they're the largest asset manager now, which is very impressive. And now I know how they got there. They keep rolling these tools out that are excellent tools. When I read a lot of the research that they have, I like it a lot. I also like First Trust. First Trust is like the third largest ETF provider in the country. So we get a lot of research in my industry. Some of it's not all that useful, to be quite frank, but a lot of it is. Fidelity provides a lot of excellent research. Vanguard provides a lot of good sales material, not really research. They don't really talk that in depth. I haven't been as fond of their services as I am of Fidelity and BlackRock. So what's really nice is that we're able to use these tools on your behalf. Fidelity provides them for us. We paid for that, by the way. We also, BlackRock actually doesn't charge us. They provide it. So that's good. We get a break from them. But in order to get access to this, you actually have to be a registered investment advisor, and they can check on that because you have a registration. And if you're not in the FINRA database, you can't get access to it. And BlackRock did this a few years ago because they were having a tough time dealing directly with the public because there are too many of you out there. So they deal with people like me instead. There are, I don't know, probably 20, 30,000 people that do what I do across the country. It's a lot easier to deal with 20 or 30,000 than it is to deal with 300 million or 50 million or 10 million for that matter. So we actually benefit from that. And I like what they have to say. Being I can't imagine $6 trillion. You know, a trillion is 1,000 billion. It's 1,000 billion. And a billion is 1,000 million. Those numbers blow my mind. But the reason that those numbers are so high is that countries around the world have Federal Reserve banks very similar to our own, and they're printing money. And we're printing money. And that's what happens. That's how the system actually works. And I know a lot of people that would wish they would stop printing all money, and they really don't know what they're wishing for. That's why they're wishing that. What they really are wishing for is that you would have no inflation. And unfortunately, that's not kind of how it works. The economy doesn't work that way. Inflation is a natural part of our economies, all economies worldwide. And you have to learn how to deal with the inflation. And to deal with it, you're not going to get guarantees. The guarantees that you get are for some portion of your money that you need to have safe. But some of your money, unless you're just unless you built a business, you could build a business, say a real estate business. Maybe you sell soap. I know somebody that does that online that's incredibly successful. So if you build a business and it generates way more cash than you spend, you're in good shape. If you don't, if you're like the vast majority of the population, you're going to have to invest in other people's businesses. It's called the stock market. That's what that is. When you buy a fund, that fund is investing in other people's businesses. How well the fund does depends on which stocks were in that fund, what kind of methods they use to select those stocks. That will kind of dictate what the performance is over time. Every time I say that, normally somebody says, well, which is the best one? There isn't a best one. It's actually a combination of various styles, strategies that you want to put together. And this is where the rubber hits the road, so to speak, when somebody that has a lot of experience, got a lot of knowledge, they can probably get you through. And that just leads me to another whole thought process. I was just looking at some of the safe investments that we would be talking about. I put safe in quotes, by the way, because everything has risk to it. Everything has risk. You've got an inflation rate. I'm going to guess that the actual inflation rate's probably around 3.5% or 4%. The government inflation rate they're reporting less than that. Lots of reasons for that, but I'm going to guess it's probably 3.5% to 4%. Just personal observation. Could not go and prove that academically, but just personal observation. So if you've got a 3.5% or 4% increase in prices, if your food's going up by that, if the bills that you pay are going up by that, you'll know what I'm talking about. I think a lot of people probably agree with that. So if you got 4% inflation and your money's not growing at least 4%, in fact, it's got to grow by 5 or 6% to be able to pay the taxes and keep up with that. Okay. So since there aren't any 5 or 6% CDs and probably not likely to have them anytime soon, what can you invest in that has a decent rate of return? Well, right now, you can match the inflation rate. There are some safer investments that are paying between 3 and 4%, whose share prices don't fluctuate like a lot of the riskier ones. And one of them would be a senior loan fund. These funds buy bank loans from huge corporations that are investment grade. They're short-term debt. They have seniority. That's why they call them senior loans, senior bank notes. They have seniority over all the other people that company may have borrowed money from. So if they were to ever get into trouble, those get paid off first. They're normally short-term in duration, which means this loan might be for a year, might be for 18 months. It takes precedence over everything else, both in the interest payments and the paying back of principal. And see, the good thing about that is, and by the way, they're all down this year a little bit. Not a lot. Not nearly as much as some other categories are. Not nearly as much as some other categories that are also supposed to be safe. Okay? So these are safer than those are. Why? Because they have precedence in the pecking order. If a company runs into trouble, they're going to get paid off. They're going to be one of the first people that gets their money back. These or notes get paid off first, or they have a higher precedence. Let me put it that way. The other thing is that they're so short-term in nature that their interest rates will go up as interest rates rise. Think about that for a second. You buy a 30-year government bond or a 20-year government bond. That interest rate is fixed for the entire 20 years. You buy a 10-year, it's fixed for the entire 10 years. These notes are maturing every 12 to 18 months, and they're going to mature with the new note that they're going to use to refinance that old note is going to have a higher interest rate. That's why the share prices of those types of funds haven't dropped nearly as much, and they're more than likely going to recover at some point in time. They will recover a lot faster than a fund that's holding government bonds that have long maturities. And that's not being taught in a lot of places. I don't hear it on other programs. I don't see it in the Wall Street Journal. I don't see it in Barron's. I don't see it on CNN, U.S. World and News Report. They're not talking about that. And I'm not sure why. because that is a really important thing. And it's a lot more important than $20 or $30 billion in tariffs. People think that that's a big deal. Let me explain something to you, Lucy. You have a $20 trillion economy. $30 billion is nothing. It is absolutely nothing. It's not a big deal. It's a big deal if you are directly impacted by it. It is. And I feel bad for the people in those industries that are going to be impacted by it. But let me tell you what's going to happen. If they fire back, this keeps going, what they're really doing is driving up the prices that we are going to pay. That's what happens. We get to pay the freight. The consumers always have to pay. You get into trade wars, who pays? The consumer. Because what happens is the prices go up. That's what happens. And in the meantime, and by the way, sometimes it's the right thing to do. Sometimes it's the right thing to pay a slightly higher price to support your own economy, to support the companies in your country. So sometimes it's the right thing. Not always, and you hope that you can avoid it, but it's practically unavoidable because it's been that way since the beginning of time. Sooner or later, somebody gets into an argument. That's what happens. That's called being a person. That's what it's called being people or a population. And so anyway, I don't think it's nowhere near as significant as the news makes it seem, because they need to get your attention, because they can't sell ads. They can't charge the rates they're charging if you're not tuning in on that casting service or your cable. See, that's one really interesting thing that's come about with the internet. Advertising is so much easier to track. Think about that. Prior to the internet, you could track direct mail because you could figure out how many people were actually calling you back. You could count the number of calls whenever you sent something out. You couldn't track television, and you couldn't track radio, and you still can't track a lot of television or a lot of radio. Like, this show can't be tracked, not traditionally. I can see how many times you've gone and downloaded, or not you, but somebody has downloaded the show. And you can do that through 955thefish.com, where it's carried as a podcast. Or you can do it on my website. It's available there too. And it's available on iTunes. So if you hear something that you like, you can actually go back, download that, clip it, play it, use it, whatever you want to do. Royalty free. I'll never sue you. Yeah, I think I got a couple minutes here before the next commercial break too. So if you got a phone call, question, or comment, you can always call us 216-901-0945 during the show, 216-901-0945. You can always reach me in the office during the week, 330-664-0700, or go to my website, bullingtoncapital.com. We're going to be talking about these topics and more upcoming workshop, and I just keep forgetting when that is. It's September 20th. That's a Thursday night. I'm going to start at 6:30. Only talk for about an hour. I'll break for refreshments. Tri-Cities Corporate College does a really good job at that. And I'll come back and I'll answer questions. And I got to tell you, when I look around at the things that are happening in the economy, it's pretty exciting. When I look at a company called Bloom Energy coming public, that's pretty exciting. When I look at the unemployment rate being so low, that's pretty exciting. The fact that wage growth is going up a little bit can be exciting too. Now that I hear the music, I'm going to have to save this excitement for when we come back. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned.
Well, I won't pretend to know what you're thinking. The dream is fading now, I'm staring at the door. I know it's over cause my feet have hit the cold floor. Check my reflection, I ain't feeling what I see.
And we're back. Hey, if you'd like to call me, you can call during the week, 216. I'm sorry. Actually, you want to call the show. It's 216-901-0945, 216-901-0945. You got a question regarding any stocks or anything? That's kind of fun to talk about occasionally. If you'd like to sign up for the workshop, you can go to Bullington Capital or call us. That phone number again, 330-664-0700. Feel free to reach out and set up an appointment if you just want to come in and talk. I really love these two new tools that we've gotten. I think they make a complicated mess a lot simpler. There are certain things that you do have to know when you're going to do a retirement plan. First of all, you really kind of have to have an idea of the amount of money that you'd like to live on. And that's a hard one for a lot of people. I got to tell you, that is where most financial plans begin and end. I don't know how much money I need. Okay. All right, well, let's take probably 80% of what you're making now, because you can probably get by on 80% without cutting too deeply. Why? Because you won't be paying Social Security on your income when you retire. So how's that? Or if you're financially independent. So that's 7.5%. So, okay, well, that gets you to 93, right? And I'm assuming that you're saving something to be able to be financially independent. So if you're saving something, you don't have to worry about that either, because now you're in the spend mode. And generally speaking, you can get by on about 80%. So just take your current income, multiply it by 0.80. You get a calculator. Can't do it in your head. That's okay. Most people can't. So take 80% of your income. Now you have to figure out how old you are and how old you want to be when you retire. Incidentally, if you take 80% of your income, divide that by 5%, that's what you're going to spend. You're going to spend 5%. It's going to be a combination of principal and income. And you're going to hope that money, if you manage it well, will last for 30 or 40 years or even longer. And so if you take 80% of your income, multiply it by 20, there you are. There you go. That's what you need. When you do that little exercise, and let's do that. I've done this so many times. So let's say you're making $60,000. Or actually, let's say you're making $70,000. The average household income with two wage earners is around $70,000. So if you're making $70,000, we're not going to count Social Security yet. Take $70,000 household income, me and my wife. 80% of that is $56,000, right? $56,000. And I don't have my calculator here, so I'm going to have to do this in my head. That'd be $1.12 million. I need $1.12 million at 5% to give me that $56,000. $1.12 million. Yeah, that's a big number. It's huge. That is a gigantic number. That's one of the reasons that Social Security is such a big deal. If I were getting, say, just got $2,000 a month, somebody with a $70,000 household income, their household Social Security is probably around $2,000 a month when they retire. So at $2,000 a month, that's $24,000. $24,000 is 5%. Hold on, I got to do this in my head. Of $480,000. So that means you don't have to save $480,000 if you're getting Social Security and you were making around $70,000 when you decided to call it quits, or when you were eligible for Social Security. That's a big deal. I mean, think about that. That saved you from having to save about $500,000. So it's really reduced the amount that you have to save. This is why it's important to get with an advisor when you're relatively young, because you're still going to have to save over $500,000. And that's a lot. That's the bad news. The good news is, if you're young, you've got a lot of time. Now, when you get closer to retirement, and this is one of the things we'll talk about at the workshop as well, when you get closer to retirement, you want to know, how much could I afford to spend being reasonably careful? How much could I afford to spend? So let's say you're not in your 40s. You're not in your 30s or 20s. Let's say you're in your mid-50s or you're in your early 60s. You've got a substantial amount put aside. You're wondering, how much would be reasonable? What would be reasonable? I just lost my hearing. There we go. It's back again. what would be reasonable for me to be able to spend during retirement? Well, I got a tool for that. And it depends on how much money you have now in your retirement savings. It depends on how much you get from your, Social Security and pensions. And a large part of it depends on how you're invested. It depends on how you're invested. If you're invested too conservatively, you're not going to be able to invest. You're not going to be able to take out nearly as much income. BlackRock has provided another tool that allows us to give you a pretty good estimate of what you could afford to spend. Now, I was talking with somebody, and it's unbelievable how staunch people are in their beliefs, even when their beliefs are based on something that's not accurate. They'll hold on to the belief rather than accept the new facts. And so BlackRock's really done a good job. I see a lot of software. I mean, I look at software constantly. I see a lot, and they've done a really good job with these tools. Is it perfect? Can you guarantee absolutely positively that these numbers are going to come out exactly like they said they would? No. And they tell you that. If you read through the disclaimers, they tell you. But they're also telling you how they arrived at their assumptions, which is a big deal. There's a lot of software out there that's free. It's all over the internet, and a lot of it's very damaging. It's risky. You got to be really careful, because when you're talking about putting together a portfolio to manage the risk, you're not talking about the returns. That's all anybody looks at. Well, the return. Let me tell you something. That's half of the equation. The other half is, how volatile was that return? I don't care how high it is. If you have a big drop that's 50% of your money and you're taking money out of the portfolio, it doesn't matter what the long-term returns are. You're going to run out of money, because it's not like a CD. It's not like a CD. The more volatile it is, the more careful you've got to be. So having said that, I really like what BlackRock has been doing. I love it. It's one of the very first software packages I've seen in this particular space that I think is a lot more realistic to what may actually happen. I got to take a real quick phone call right now. I got Carl. Hey, you're on the Bullington Capital Report.
Hello, Bill. I called you a couple weeks ago about a stock called Cedar Fair, symbol FUN.
Yep.
And it looks like it's been hammered pretty good here over the past month due to problems with attendance and revenues and so forth. And just wanted to see what you think of the stock. It's paying a pretty nice dividend, and whether you think it's going to have some upside potential.
Well, let me take a look. I'll pull it up here really quickly. And I'm going to go to my trusty Y charts. So revenue is $1.3 billion in the past 12 months. Was down 3% year over year. The profits were down 38%, so evidently they're spending something. They're probably redoing some of the rides, and that cost them money. Profit margin was 5%. Let me see what the long-term profit margins are on that, because that would be more important. The most recent profit margin. Yeah. That one's got, that one fluctuates a lot. Actually, Cedar Fair's, I like it. They own Cedar Point. They own a bunch of stuff, actually. And the only problem with that is, it's been kind of volatile. It's been really volatile. And when I say volatile, I don't mean just the share price. I mean the profit margins have also been really volatile. The more volatile the profit margins are, the more volatile the share price is going to be. So when I look at the market cap, that's the value of the stock. It's $2.8 billion, and these guys have revenue of $1.3 billion. So it's roughly a little over 2 times. It's like a little over 2 times their revenues. I can tell you, if you look at the long-term profit margin, that's right about average for where that company is. So when it was a little higher a few months ago, the share price, the valuation was slightly higher than its longer-term average. So right now, it's right around average. I hear the music. Carl, that means I got to go. If you want to call back in next week, we can finish this conversation. And for the rest of you, my name is Bill Bullington. I'm here every Saturday morning from 11 to noon. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.